Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct. With reporting season well underway here in Australia, I caught up with Julius Garofali of Stockbroking to find out exactly what impact this could have on the ASX and how traders should trade it. Julius, a pleasure to see you as always. Thanks so much for joining us again today.
You're welcome.
Okay, the ASX has seen some huge drives really over the last 3 weeks. How much of a role has reporting season had to play in that?
A huge role, actually. What reporting season does, it confirms to the market the profitability of companies, the profits that they report, and also the future earnings guidance that they give to the market. Certainly what we've seen in this reporting season is that a lower Aussie dollar, a lower interest rate environment has actually flown through to produce some really good results for companies. So thus far for the week gone past, we've actually seen confirmation of this flow through into some pretty solid reports. Give or take a few bad, of course, a few bad reports from companies. You'd find that a classic case in point would be Macquarie Bank came out with their operational briefing this week on Tuesday. They surprised the market on the upside, saying that their guidance for their financial year, which is 2015, next month's reporting, $1.4 to $1.52 billion on the top range, which is up 10 to 20%. So the market really got excited about that, and that overshoots the index. So the stock actually went up from $58 to $72, just upstairs now, seeing the last price. That moves the market. Macquarie being in the index, you'll see that would therefore lift the index as a whole. Here's an interesting example. BHP is about 6.5% of the ASX 200. For every $1 BHP moves, the index would move 11 points.
And Macquarie, as our viewers will remember, was one of your stock picks in our last interview from last month. So I guess great shout there. Now, as part of that, were there any breakout surprise stocks perhaps?
Yeah, there certainly were, Natalie. There was three quite noticeable this week: Domino's Pizza and Woodside Petroleum, Toll Holdings. Domino's Pizza had a cracking profit results, up 67%. Saw the stock go up 35%. That's been a real stellar performer over the past 3 years, and in particular, Woodside Petroleum, fantastic. Brilliantly well-run business, blue chip oil company, specialising in LNG. They came out with a dividend hike of about 40% of $1.44 US per share in dividends. I mean, that's in Australian dollars $1.88, so that's 5% off just one dividend alone. So that stock went up quite a bit this week as well. Toll Holdings, something different, not report, but Japan Post came out with a takeover bid for the stock. And that was $9.04. That's up from $6. So there's almost a 50% premium to the last closing price. So a lot of attention there. I'm actually advising clients take that, because why wait 3 months plus for a takeover from a foreign entity to be approved? I'm switching into a domestic logistics transport company called Horizon. In around $5, we've got a price target of $5.35, yields at 5%. So, I like to take action when it needs to. But yeah, they're the three surprises, and I think the market's pretty happy with that.
You mentioned there sort of the direction that you're heading in. How are you advising clients to trade earnings season then?
Well, Natalie, if companies are coming out with really good reports, and that builds their share price to trade, beyond their historical PE valuations or stress PE, I find that I like to not get caught up in the hype, take profits and be very disciplined to that. And I think that the same goes both ways. If a company has reported a disappointing result, and they've missed guidance and the market overreacts on the downside, I like to take advantage of that to some degree, and that's essentially when you get stocks cheaper. So it goes both ways.
So we've spoken a lot, obviously, about rallies, about some of the uptrends that we've noted, but with reporting season also naturally comes some downsides. Who's performed perhaps not so well or exposed themselves to further losses?
Two companies that disappointed this reporting season was IINet and Gemworth. Just this morning, IINet reported Revenue was fine, but the margins were a little lower than guidance. The stock actually this morning's down 7%. Quick run off our numbers is earnings cut of about 15% for the next 3 years. Next one's Gemworth. Gemworth is a low doc mortgage insurance lender. So it provides mortgage insurance to lenders who have a loan to value book of greater than 90%. They actually lost one of their biggest clients, Westpac. That's going to impact their gross written premiums by about 14%. And the stock actually has fallen about 23% on the back of that. So quite disappointing when you miss the mark.
Julius, always great to receive your comments. Thanks very much. We look forward to catching up with you again in the future.
So do I, Natalie. Thanks.
That is all we've got time for right now, but we look forward to catching up with Julius again in the near future. For now, though, it's goodbye from me.